Which stock market or assets is likely to do well in 2021? That's going to be the topic of today's video. Now, 1 or 2 weeks ago, I did a webinar where I talked about the trends of 2020 and going on to 2021. Now, what's interesting is 2020 last year was very surprising for a number of reasons. Now, first of all, most people were surprised about how quickly stock markets recovered from the global pandemic and lockdowns. But added to that, a lot of the markets that did well were quite surprising. So for example, the South Korean stock market was the best performing stock market in the world last year. Yes, the Nasdaq did slightly better, but the US stock market as a whole didn't do as well as the South Korean stock market as a whole. And the US was only about the 9th or 10th best performing stock market. Taiwan, China, some of the Nordic countries in Europe all did better than the United States. And a lot of those countries were out of fashion a few years ago. So for example, the Chinese stock market, as I mentioned before, has been one of the worst performing, if not the worst performing stock market in the world for about 14 or 15 years. Taiwan and South Korea haven't done as badly, but their stock markets haven't performed particularly that well compared to the US, and some of those European markets have been much the same. When we talk about some of the worst performing stock markets last year, most of them are either in Latin America or they're in Europe, like Greece and the United Kingdom. And a lot of the commonalities there are things like currency weakness and or commodity weakness, because of course the UK stock market is based on, not completely based on, but obviously it's got a higher allocation to BP, Shell. Those financial companies, those oil and gas companies are bigger on the UK stock market than say the US stock market, which is more linked to tech. And obviously Latin America commodities is a huge part of the stock market as well. That's not the only reason, of course, because Australia has also got a big allocation to commodities, and Australia wasn't one of the best performing or worst performing stock markets last year. But of course, in general, last year was a good time for the stock market. Now, 2021 could be very interesting for a number of reasons. We've had a situation where the Nasdaq has outperformed by a significant amount. So for example, last year the Nasdaq did 43%, whilst the S&P and Dow Jones did closer to 10 to 17%, depending on what matrix you use and if you reinvested dividends. In addition to that, you have a situation where the US stock markets in general have outperformed international stock markets for a number of years. Not every year, but for a number of years in general. So this year, if you put a gun to my head, I would actually say it's likely that some of the international stock markets might beat the US stock market. However, a caveat to that is this. Long term, I would not bet against the US stock markets outperforming as they have done for 50 to 100 years. So that doesn't mean you should sell all of your S&P 500, Dow Jones or Nasdaq ETFs and go into an international market that doesn't actually focus on the US, like an ETF which is total world minus the US. There are certain ETFs like that. I'm not saying that at all. I'm just saying after many years of the US outperforming, there's at least a heightened chance that other stock markets could do well. So for example, the United Kingdom, now Brexit has been sorted out one way or the other, rightly or wrongly, it's done now. There might be some teething problems, but it's done. So the UK and Europe more generally, which by the way, the European stock markets fell by about 2% last year, even though the German DAX hit record highs. Mainland European stocks and UK stocks might benefit from that, i.e. Brexit being sorted out, but also from the fact that valuations are much better. So the UK FTSE 100 has a dividend yield of 3.5 to 4% compared to just over 1% for the US stock markets. And the price to earnings ratios are much better than the US stock market. So it wouldn't be surprising if the UK does quite well the next few years, at least in terms of the stock market. And also you've got to remember that once the vaccine has been administered, you would think that would be good for oil prices, some of the banks, some of the traditional firms, and that could bode well for the UK, French and other European stock markets, and maybe also markets like the Japanese stock market and some others which haven't always performed that well. However, there is a counter argument to that, which is why you should always be diversified. That counter argument goes like this. You can't use traditional price to earnings ratios to value technology stocks for a simple reason that Amazon looked undervalued, or even overvalued, should I say, in 2000, 2001, 2002, 2003, 2004, and so on, right? Until recently, Amazon looked incredibly overvalued. But there's a reason for that Jeff Bezos was playing the long game. He was reinvesting money back into the business. He was focusing on sales growth. He wasn't just focusing on short-term profitability. So the balance sheet might not have looked great for many years, but he was playing the long game. Obviously, it was going to be risky to just invest all your money into Amazon, but the argument is that with tech stocks, sales growth and other variables will eventually lead to better profitability. That's the argument some people use for Tesla as well and some other tech stocks. Now, I would say that stock picking tech stocks is even more dangerous than normal stocks. But the argument is that even though the Nasdaq looks much more overvalued than the S&P 500 and miles more overvalued than, say, the UK or Chinese stock market, which looks very cheap, that actually you can't compare like for like. I'm not completely convinced by that argument, but I do think we are moving more and more to a digital world. And I'm going to be talking about that more in my upcoming video about Africa and digitalization, which will come in a few days. So the bottom line is, I have a hunch that some of those markets that have not exactly had a good time recently, like the UK, mainland Europe, some emerging markets might do quite well in the next few years and indeed this year. But that doesn't mean that me personally, when it comes to my own portfolio, I'm selling loads of US stocks. That's not the case at all. I'm not selling out. I'm actually adding to my positions in the US market, but I'm just moving slightly towards some of those areas that look undervalued. And indeed, last year I did increase my allocations to the UK a bit. I've never really put too much allocation in the UK, even though I'm British, but for the first time in many years, I significantly increased my allocations to the UK market because it looked so incredibly cheap at one point when it was 5,800, 5,900, and now it's close to 6,800. Another trend I see though is some of the existing trends I still think have some room to go. So the FANG stocks, when it comes to technology, for the next 6 months or so, we might still have partial lockdowns. In addition to that, ESG investing, especially things like renewable energies and alternative energies, because so many governments, not just the new government in the US with the Biden administration, are putting a lot of money into renewable energy funds. A lot of them did incredibly well last year. They went up between 30 and 50% in general. I still think there could be room to run. And let's not forget, a lot of the oil companies like Shell and BP are pumping a lot of money into renewable energies. They're no longer just oil and gas companies, they're more just like energy companies that are investing into new energy as well as old energy. So those are some of the trends I see this year. And finally, I do think there could be a pickup in some kind of real estate funds. Now, real estate, including REITs and real estate funds, does look a lot more risky than it did previously for obvious reasons. More people are working from home. You know, there's no guarantee that city centres in London, New York and so on will ever recover to where they were before. They might do or they might not do, but it's a big risk. However, I do see real estate funds which have never completely recovered from the crash last year, at least having somewhat of a good year, because people are going to be looking for other areas. The S&P 500, the Nasdaq, we all know they're good long-term bets. If you just want to buy and hold for 20 or 30 years, they're great long-term bets, but they have gone up a lot in the last 10 years or so. So I do think a percentage of people, especially once the vaccine is out and the economy is coming back, they're going to want to look for those areas like maybe the UK, like a real estate fund, maybe even something like a Chinese fund, something that looks quite deflated and undervalued, or at least undervalued to a certain extent. And real estate funds are very similar to the UK market. They're about 15 to 20% below their all-time peaks. They have a 3 to 5% dividend yield, and they look relatively cheap. But like always, staying diversified, staying long-term is much better than going from one extreme to the other. In 2016, 17, 18, and 19, I saw so many people move out of US stock markets to pick the UK stock market, and that was because they thought, oh, it looks so undervalued. But don't always bet that markets are going to just change like that, because markets might not always be efficient, but they're not stupid either. And the fact that the US stock market is looking a bit more overvalued than, say, the UK or European stock market is because investors see it as less risky long term. Markets are not stupid. Yes, they panic. Yes, sometimes they can be irrational, but those cheaper valuations you see in, say, China or even the UK are cheap for a reason. They are cheaper because they're a bit riskier. So I'm increasing my allocations slightly, but that's all.